All right, so today I wanted to do a video on all of the ETFs that I'm buying, or dollar cost averaging. I haven't done this in a long time, so I wanted to do that. First things first, if you get value out of the video, please like, subscribe, comment, check out those links below. So getting right into it here, the reason that the first question that probably would be asked is always the old, do you just passively, invest through ETFs, or do you buy stocks, or do you do a combination of the two? I do a combination of the two, and the reason for that is I believe diversification is overrated, but not entirely overrated. And the other reason that I buy ETFs is I want to be able to, just sell covered calls on them and make a little bit of extra money. And not to mention too, that's an easy way to outperform the market over the long run, is to buy the market and sell covered calls. You can add an extra 1%, 2%, 3% per year if you are patient and know what you're talking about, for lack of a better way of putting it. So the first one here is the NASDAQ, the QQQ. With most of these, there is numerous versions of them. I buy these for mainly because I want the most liquidity. At least as far as this goes. So the NASDAQ, the reason for the NASDAQ is the NASDAQ has outperformed over the long run, and it has a lot of liquidity for options. So that's the reason to buy the NASDAQ, and it's large cap, specifically tech names mostly. But the one other caveat that I would throw out here when it comes to index investing or ETF investing is a lot of people make a very obvious mistake when you think about it, but they don't really think about it, is people will buy ETFs that have a lot of overlap. For example, they will buy the SPY and they'll buy VTI, which has basically the same, the top 50% is almost exactly the same. So that's something to keep in mind, is you don't want to be buying ones where there's a lot of overlap. The next one is RSP. Why RSP? Because RSP is the equal weighted S&P, for the people that don't know that. The reason for that over the regular S&P is, number one, I don't want that massive overlap with the NASDAQ, and like SPY and VOO and the NASDAQ, there's a lot of overlap, So that's why I don't buy this. The reason for that too is that this provides a more provides more of a value approach as opposed to more of a growthy approach. So this is something you'll notice as I go over things here, is that everything is different, right? There's a very obvious reason and a very clear reason for owning it. So the equal weight, again, over the long run, it has underperformed slightly, but it provides a diversification. And also have to keep in mind that if you go back like 100 years, growth actually underperforms value. So even though over the last 20, 30 years, growth has outperformed value, there's no guarantee that that's going to happen in the future. But there really isn't. And not to mention too, in down markets, usually value outperforms. So that's another reason why I own this one. The next one is VO. This is the mid-cap ETF. Again, over time, over the long run, small caps and mid caps typically outperform large caps, which is something that's not happened recently. But again, eventually that trend probably will change. It probably will change at some point. The reason for VO, again, is it gets you that exposure to mid caps. The other obvious reason for buying ETFs is over stocks is over the long run, ETFs, if you're picking the right ones, if you're picking some of the thematic ones or some of the more exotic ones, they easily could be down over the long run. But over the long run, the more broad ETFs will go up eventually, right? It's not a guarantee, but it's as close to a guarantee as you can imagine. So that's the other obvious reason for buying ETFs over individual stocks. Like if you go down, 20, 30 years in the future, even your Apples, your Googles, like Amazon, I kind of doubt, but like, would anyone be surprised if Google is not a company that anyone even knows about 20 or 30 years from now? Like, I could easily see that. I'm not saying I'm predicting it, but you easily could see it. And the beauty of ETFs is that can happen, and you'll be fine. Like, you'll be absolutely fine. But if Google's a top 5 or a top 10 or even your largest position, you're gonna suffer because of it if they disappear. So that's another obvious reason. The next one is VB. This is the small cap ETF, obviously because it provides even more diversification. There's going to be no small cap companies in the SPY, in RSP, in QQQ. They will be in VTI, but they're going to have an extremely small position in there, like incredibly small. So that's the reason for that. And like I already mentioned, small caps over the long run typically do outperform. So that's the other reason there. The next one is VIG. Now this is the one exception to the rule. This one definitely is going to have quite a bit of overlap between the QQQs and RSP. But the reason for this is I just like dividends, and I like dividend growth specifically. So this is the one that that definitely does break my rule, but I don't ever plan on any ETF being more than maybe 3-4% of the portfolio. And this one is the exception to the rule because I just really like that dividend growth. And not to mention too, it will change over time, right? Like it will change over time. But if you look at the top companies in here, like Broadcom's top 10 in the NASDAQ, Microsoft's top 10 in the NASDAQ, Apple, Costco is in there, I know for sure. I'm not sure if JP Morgan, Eli Lilly, Visa, MasterCard, I believe they're in the NYSE. ExxonMobil definitely isn't. So there definitely is a decent amount of overlap there. But again, this is a completely different index, right? That it is dividend growth. So there definitely is a little bit of overlap, but it's not entirely overlap. Like if you look at the overlap between VTI and SPY, it is almost the exact same top 10, even percentage. So this one definitely has overlap, but it's not as bad as the other examples that I've used. The next one, getting out of America now, is going to be VDY. This is this is a high dividend yield one, but technically, if you look at any Canadian ETF, they're all going to be higher in dividend because the top Canadian companies are disproportionately your oil companies, your banks, and your telecoms, which all just happen to pay higher dividends. So the reason I like this one is this one's performed pretty much the best, at least of the major ones, of the top 5 to 10 Canadian ETFs by assets under management. This one's performed pretty much the best from what I could tell, and it pays a 4.37% dividend, and they're actually growing it quite nicely, right? They're growing it quite nicely. I mean, if you go back 10 years, your yield on cost is like 7.5%. So I really like that. So that's why I own this one. The next one is going to be next one's going to be IEFA. Now, this is an international one, and the reason for this is also it should be pretty obvious. But if you look at the last 6 months or so, the American major indexes have underperformed a lot of these international indexes, and that's something that I don't think is going to go away. I think that this probably is a sign of the future. I think that, if I had to pick between any major, America, the NASDAQ or the S&P, or any major international index, I still would pick the NASDAQ or the S&P. But I think that the days of the American indexes just dominating is probably a thing of the past, at least for the near future, because a lot of people they've sold off some of their American assets and they've bought more local ones. So I definitely think, even though I think that they probably will still underperform, they've underperformed by literally more than 50% over the last decade. And I think that they probably will, in my opinion, they still will underperform, but it's not going to be to the same extent, right? It's not going to be to the same extent. And also, I like the fact it's paying about a 3% dividend. They are growing that over time, so it provides a solid dividend as well, and it is growing as well over time. They pay semi-annually, which I really don't like, but again, what can you do there? And then the last one I wanted to bring up here is the only thematic ETF, URA, and this is one that's actually been up. This one's been on an absolute tear recently. If you look at this is going out too far here. Let's just look at the price charts. Year to date, I mean, they actually are only up slightly on the year, but if you'd have bought them back at their lows, which is just over $20 a share, you're up 57%. And keep in mind, this is less than 2 months. So absolutely insane growth here. Obviously, uranium is going to be quite volatile. The reason for buying this is I'm fairly bullish on uranium, right? I mean, it looks like a lot of places across the world are hell-bent on transitioning away from oil and gas, and the only way we're going to do that is with uranium, right? The idea that we're going to transition 100% towards renewables, especially in a country like Canada or United States where it can get very cold in the wintertime, especially Canada, is a pipe dream, right? So we need something that can provide base load regardless of whether it's sunny or windy or not. And if it's not going to be oil and gas, the best alternative is uranium. And frankly, uranium is arguably superior to oil and gas. So uranium, like this ETF definitely is a little bit speculative, but I think it's worth it. So anyway, that's what I wanted to bring up today. If you liked the video, like I said, please like, subscribe, check out those links below, and stay tuned for more.